So the question is, why take action? And the answer is, you got to have courage. A little bit of courage, even though you're incentivized to sit in your hands. And courage, by definition, means acting despite fear. Mm-hmm. And that's the wisdom of the day.
Welcome to the Generations of Wealth podcast. I am your host, Derek Dombeck, and today we are talking about fund management, how to, start a fund, establish a fund, what to do with it. We're talking about market cycles, and we're doing all this with Mike Zlotnik. And I had the pleasure of being on Mike's podcast a few weeks back. And but before I bring on Mike, it's time to, pay homage to you. Thank you for following us. Thanks for being here. We really, really appreciate it. And if there's anything I can do to help you, don't hesitate to reach out to generationsofwealth.com, derekdombeck.com, or shoot me an email, derek@globalgow.com. And, that is what this is supposed to be about. Build your network, use this network, and accomplish your goals. So with that, let's bring on Mike Zlotnik. And here he is, Mr. Big Mike himself, Mike Zlotnik. Welcome to the Generations of Wealth show.
Thanks, Derek. Appreciate your kind invitation.
We got the pleasure of recording a podcast on your show not too long ago, and I highly recommend everybody go and follow the Big Mike Fund podcast, and specifically my show, of course. No, I'm just kidding. But before we dive into your expertise, why don't you just tell us a little bit about your background and where you came from, and then we'll definitely pick your brain a lot, because you are doing some incredible things.
Thanks, Derek. Yeah, I come from, you with a James Bond movie called From Russia with Love. Well, I didn't come from Russia. I come from Moldova originally, a small republic of the former USSR. I came to the United States in '89, and I am a U.S. citizen, a U.S. patriot. I've lived most of my life here. Lovely family, live in Brooklyn, New York. My wife of 20, coming up in 26 years. I have 4 kids, 4 monkeys and a cat. Well, cat is real, and then 4 kids. U.S. educated, actually. We're chatting before the show. I studied computer science and mathematics. Had a career in technology for almost 15 years, and then started investing in real estate passively, part-time, in 2000, just basically still being a technology professional, and then switched to real estate full-time 2009. Became a fund manager focused on real estate investing. So never look back. That was at the end of my technology career and start of my full-time real estate career. But I did it. I went active after being 9 years passive. So for me, it was just a natural fit. It was my passion to be a real estate investor. So that's the journey.
Well, I know from you and I talking on your show and just other stuff about you, like you're very heavy into fund management now, but if we kind of back that down to just how do you look at the different market cycles, and how do you know before you start raising money for a project, how do you know where you are in the cycle? And I guess maybe talk about that.
Sure. So the more you know, the more you don't know. Like, I'm listening now to Howard Marks and his book on market cycles. Now, he's a stock market investor, and he's a famous publicly traded securities investor, but there's a lot of wisdoms from him. And I was watching a video that he put together on risk. The risk is hidden. The risk is everywhere. You never know how much risk is out there. Market cycles, there's a risk at the bottom of the cycle, there's a risk at the peak of the cycle. So all these discussions are all theoretical, right? We don't know, and past doesn't guarantee the future, right? Past performance is not indicative of future outcomes. All we know is lessons. We observe the past. We do know that markets go through cycle, public markets, real estate markets. Obviously, real estate has sectors. There's residential, there's commercial, various parts of commercial, there's multifamily, industrial, storage, open air shopping, et cetera, et cetera. And each sub-strategy acts differently. On top of that, you got regional cycles, right? So things can go really well one region under one administration when there's appropriate energy policy, and then another administration comes in and different energy policy, and that region goes, the economy really weakens. So all of this, I'm just going to say, is when you look at this, you have to take all these variables into the equation and think about what's right for each strategy location. Like, to give you an example, we're recording this in May 2025. We know that multifamily market on a broad basis has gone through a substantial peak in, let's call it 22, and a correction, fast and furious change in the interest rates, oversupply in some markets, impact of high insurance, and the market has been significantly dislocated, and now it's trading at a steep discount. Is this the bottom of the market? We don't know, but we're somewhere towards the bottom based on many factors. Now, I just came back from San Diego. We have an upcoming project there called the Headquarters at Seaport. It's a beautiful property, prime real estate. And we were separately at a conference that I attended, Passive Pockets, and I looked at it. And one of the speakers brought retail as an asset class and where it is in the cycle. And it's still in the expansion. It's not even oversupply. It's not in recession. So certain asset classes continue to chime along because there's no supply. Like retail, open air shopping, these centers, it's been no new product. And in the post-COVID world, many people want to go out. Experiential real estate picked up demand. As a result, these concepts continue to see great foot traffic, and they continue to do really well. So all I'm going to say is it's not a binary answer. Right now, we're at the bottom of the cycle, for example, in the multifamily real estate, most likely, again, probabilistically. On the other side, we're still in the strong expansion in open air shopping, but again, all real estate is local. So I'm going to stop for a second and really let you ask follow-up questions and folks digest this. You always have to be aware there is a cycle. Whatever comes up at some point may come down, reversion to the mean. These things do happen. But at the same time, being a good observer and a scholar is very important in making a decision. Is this a time to write a check, or is it a time to sit in your hands?
Yeah, and that's why I love the way that you analyze deals or analyze markets, analyze all of this stuff, because you have a different mindset than I do, to a lot of degrees. Like, I definitely want the research and I want the data, but I thrive in down markets with what I do. My creative deal structuring is better served when there's blood in the streets, and there's people that and I can make money in any real estate market, but I look for those down times. And I mean, just to give you an example, I mentioned before we started recording, I'm going to go to contract on a property today, and this guy, this was a dead real estate lead that we were $100,000 apart. And yesterday, he got in contact with us, and we're going to contract today. Why? What has changed? The circumstances have changed, and the market itself hasn't shifted a lot, but the average days to sell a property is going up, and he ran out of time, So I say all that to, I guess, ask the next question, right? Like, what do you look for? Do you look for uptrends? Do you look for downtrends to start doing deals when it bottoms out? What's your personal preference?
Sure, it's a great question, Derek. What I would say is, some people say trend is different sometimes. So open air shopping right now, the trend is strong. So for that asset class that's still in the expansion, you can continue to invest with a trend. Of course, you have to monitor for potential future supply-demand changes. But in general, a trend could be a trend for a long time. But there are also market conditions when you're looking for the bottom of the market. So the trend has been slow downwards or maybe rapid downwards. At some point, the trend breaks, and then the down market, the blood in the street, is so high that it creates a great buying opportunity. Will you know for sure that it's a great buying opportunity? You may not know, but you know directionally you're close to the bottom. Then you start looking at these fundamental data metrics that tell you, yeah, I mean, at this price, using all these factors, it's a great deal. So what are these factors? And this, I agree with you. We all love to buy deals when the market is down. I mean, this is the best buying opportunities by far, because you will benefit from for two reasons. One, with market recovery. For two, is your deal. Assuming that you're getting a great deal because you have a motivated seller situation and you're getting a deal better than, let's call it a kind of open market transaction. But what is market, right? It's supply demand of deals, and when you have motivated sellers, you may get a great deal. So what are these factors, right? And you start looking at these fundamental factors in real estate. So what I'm saying is the trend is like a momentum buying. When things are going well, you can keep doing that. You could also shift into a deep value buy, and it sounds like that transaction is a deep value buy with the structured finance, seller finance, some creative finance. So when you can do that, you could do this, by the way, in residential, commercial deals. I have an associate of mine who does self-storage deals, and all he does is seller finance, old 75-year-old sellers and mom and pop facilities, but he has some extra expansion real estate, and he can go build and do his value add that way. So the wisdom is there's no right or wrong, but you could look at things, reconstruction cost, like what does it cost to build a similar house, and then you discount for the age of the current construction versus the past, right? Two, you could look at the income approach. What kind of income are you getting on a property versus the cost of finance? How conservative is your leverage? And if you add all these basic factors together, you look at the deal and you say, I can't lose on this deal. There's no way for me to lose. Now, is it going to be a home run or a double or a triple? It's another question. But when you get to this point in time, then you don't need to be looking at the trend. Yeah, the trend has been down, but you can't lose in this deal, so it doesn't matter. Even if the trend is still a little more down, at some point it'll bottom out. That's kind of the wisdom.
Right. Well, I love that. Let's kind of dive more into the actual fund management and differences between debt funds, equity funds, your everyday world. Tell us about it.
Yeah, I'll keep it simple. So this morning I recorded a short video, actually, what's the difference between publicly traded REITs, real estate investment trusts, and then private real estate funds. I'll start with that, right? The really basic stuff. So most people understand, well, why would I ever want to invest into private real estate fund when I can go buy a real estate REIT? You absolutely can do that. And there are beauties and curses in both, the advantages and disadvantages. So one of the biggest advantages of publicly traded REITs, they are funds. They're publicly traded funds, and you have liquidity. You could buy and sell the same way you could buy and sell Google stock, right? You have liquidity. The curse is it's a publicly traded security. It's a very efficient market. Information travels fast. So when the bad news hits, before you know, the stock can fall in price, or the stock price can move up. So you could have it's the efficient markets don't also give you great opportunities. You can't go make a deal and buy Google stock if it's trading at $200 a share. You can get suddenly a deal for $180 a share. It doesn't happen unless you're writing $50 billion check to Google and they need to raise capital, right? They may not give you a discount, and the discount they may give you is a tiny discount to the market price. But if in private real estate, as a fund manager, you could get into great deals. Like the situations you have, motivated seller situations, distressed property, distressed asset. You also have situations where the bank is involved, right? There's some kind of distress. on the property, and then you're dealing with the negotiation of a bank, good old short sales, right?
Mhm.
So you have ability to negotiate much better deal, seller financing terms, right? Private real estate funds just work as a collection of these multiple individual deals that go in a fund. Now, REITs typically also large. They $1 billion REIT or $2 billion REIT, and then industrial REITs. Sometimes they are self-storage REITs or some other specialty REITs, but they have a national footprint. They operate in a big scale, and they have a big money deployment problem. If $1 billion REIT is trying to acquire properties, they got to put to work 30, 40, $50 million on a small check size. When you're dealing with private funds, it could be 25, $50 million fund, and they're solving very different problem. Other benefits of private funds, I'll just give you another really interesting difference is, some folks haven't heard about this, but it's a very powerful strategy that many investors utilize. They have self-directed IRA money, and they invest into private funds, and then they convert from traditional to Roth at a discount to value. They get a discounted valuation through the investment. It's a very powerful strategy. So if you do it publicly REIT, you can't. There's a market price every day. It's liquid. Private fund or a syndication, you could write a 100K check, and 3 months down the road, you can't redeem, you can't get out. If you were to sell this investment, you would have to take a discount. It's kind of funny how it works. But for the sake of the IRS, you get a valuation letter, it's not worth 100, it's worth, I'm using an example, 50 or 70 or whatever, discounted number. So you have some advantages of these funds, and you can use some of these techniques to actually save on taxes. Also, private real estate deals or funds could be structured to give you a ton of depreciation benefits. It looks like we're going to get 100% bonus renewed. You know what it's going to do? It's going to increase demand. Why people going to buy? And then they're going to do cost segregation studies. They're going to take tax benefits. Most of these public REITs don't do that, but private deals could be structured with heavy depreciation benefits. So the world of funds, and you asked me with debt versus equity. Yes, you could have funds that are focused on private credit, hard money lending fund, for sake of simplicity. You need to borrow money on a fix and flip project. The bank's not lending well. You go to one of these private credit funds, you get hard money loan. So there are funds that focus on that. And there are funds that focus on certain equity investments. There are also syndications. I wanted to differentiate for folks what is syndication, what is a fund. And we've done debt syndications, we've done equity syndications. The concept is still the same. So you have one asset, right? Whether it's a loan on a property, you can do a $5 million loan and syndicate it to, 50 investors, right? Or you can do $5 million equity investments and you can syndicate it to 50 equity investors. The same way funds do the same thing. They just collect a bunch of these notes or debt investments and they put it in a fund. You have many investors and you have many investments. That's what the fund does. Diversifies for you. Syndication, typically you have one or two assets, whether it's an investment in a debt or investment in equity, and you have many investors. So that's the structure. Focus, you could have self-storage funds, industrial funds, you can have different strategy funds, you can do residential lending funds, you can do residential equity funds, buy portfolios of turnkey homes. So I'm going to stop for a second, but there's a broad range of options out there.
Struggling to keep your books straight? Or worse, are you dreading tax season? Trust Point Bookkeeping, led by Derek Dombeck, brings over 20 years of experience helping real estate investors stay organized, audit-proof, and tax-ready year-round. Whether you need basic transaction tracking or full-service invoicing and payroll, Tracy's QuickBooks online expertise and personalized support make your financials stress-free. Don't let messy books hold your business back. Head to trustpointbookkeeping.com and schedule your free consultation today.
Yeah, and I think that before I ever got involved in my first fund, when we owned a hard money lending company, I guess I was afraid of it, right? There's so many unknowns. You start thinking, okay, I have to be SEC compliant, and there's all these, I guess, the monster under the bed scenarios. The reality of it is, and I'd love your opinion, the reality of it is when you do get involved and you structure your first fund, and yes, there's a cost to that with your SEC attorney and that stuff, but it's really not that hard. What do you think now that you've been doing this for a long time?
Agreed. So I'll tell you this, it's not definitely not hard. There's a compliance. The attorneys who operate in the space are generally specialists. So you will get hopefully competent advice as far as what type of offering you need to put together. There's a 506C or 506B. These are terms that I use. C is where you can only take accredited investors and you have to verify accreditation, but you can promote, you can advertise. 506B, you can only go to existing relationships. You can market to people you know. All these things are, I won't call them mechanical, but they are details, which are obviously important, the compliance details, but with a competent attorney, you'll follow the right process. You'll file with SEC, you will file with individual states wherever you're raising capital. So there are requirements, but it's nothing more than any business. You get a license, you get certain rules and regulations. If you follow them, you can stay in business, you can operate that business. It's not, all I can tell you that we do day in and day out with high quality attorneys, and they just crank out another deal. It's not a rocket science at all. So all I'm going to say is for those who are aspiring to do a fund, I'm happy to chat with you, give you a couple of minutes just to give you a little bit of feedback. And just to be very clear, some folks want to start a fund, and if the fund is too small, not worth doing it. Some folks start with one-off syndications, one-off deals, and they go to a fund model, right? So it all depends on what you're trying to accomplish, how much capital you think you're going to raise, what you're going to invest in. Is this something you're passionate about? Some people think, well, let's do a fund. Are you passionate about running a fund? Do you understand ins and outs? There are some responsibilities related to that. Now, it doesn't mean it's a bad thing. It just means you just have to understand. Go into that business with eyes wide open.
Yeah, I would say the big thing that I learned through running several funds over the years was the investor communication is so important. And there was, at that point in my career, I had a business partner that I co-owned the hard money lending business with. And he was more of an introvert, I'm more of an extrovert. So we split those duties. He kind of handled the back end and I handled the people stuff, and it was great. And I know that anytime that I hear of an investor who was interested in bringing their money to us, they may have even been getting better returns, but I would always ask them why were they, coming to us? And it was either one of two reasons. We are out in our community, educating and giving back and teaching as many people as we can. So they like that. But the second one was, they'd say, well, I borrowed my money to, Bob Smith, who I met at the Real Estate Investor Association meeting, and I just never knew what was going on. He never communicated with me. Right. And I would hear that time and time again. So if you're out there just raising money individually or in a fund or doing syndications, just make sure you have a plan to stay in good, healthy communication with your investors. And then it gets, Mike, you can give me your feedback, but it gets easier and easier because they are singing your praises. They are raising money for you just by referral, right? So
yeah. I think you got it right. I just had a couple of comments, but it's so interesting. Whenever you loan somebody money or invest with somebody, the first thing you need to do is to observe how they communicate with you. Communication, like you said, is probably one of the most important things. And first of all, hopefully you had an opportunity to get to know, like, and trust, do some due diligence before you give them a check. Obviously, if you're loaning somebody money, you got to do due diligence. If you're investing in equity, you got to do due diligence. Basic due diligence, right? Just at least understand what the business plan is, who you're investing with, the personality. The jockey is always ahead of the horse. So going back to the points you mentioned, communication is so important. We do today as fund managers, as syndicators, whoever we write a check with, or whoever gives us a check, it's a two-way street. this communication has always got to be good. And if it's not good, you need to be open to improve. We try to listen. Investors give us a check and they don't like something, we will take their constructive feedback. So this two-way communication is always important to understand both points of view, help answer questions, and help solve any issues. And is it also true when you write a check into a deal? Not every deal will go perfectly, but good communications will go long ways to help at least all parties to be on the same page. So I will say that investor relation function is an important function. We have a great head of investor relations. It took us a while to find that person, but it's a very important function. So I am completely affirming what you said, that whatever you do, whether you're both an investor or looking to raise capital, that's a very important function. And going back to the fund manager has really only three functions, right? One is to raise capital, maintain these relations through investor relations, right?
Mhm.
Two, find deals, right? Underwrite deals, and then obviously deploy capital and manage the deals through a life cycle. So it's capital raising and then investor relations on the other side, and then finding deals and then managing them through the life cycle. The business is not that difficult. It's just a combination of a few important functions. And of course, you got to get better at each of those functions. If you do good at one or two and not good at the other, then the business doesn't click the way it needs to click.
Yep, absolutely. Well, Mike, what's one question I should have asked you that I didn't as we start to wind down here?
So one question today that I get quite a bit, and literally I got the question right before this call. We had another call with an investor. So clearly today, May 25, commercial markets at least have gone through a level of change, reset. The opportunities today are much better than the opportunities a few years ago. I mean, you mentioned this, I mentioned this, and asked the question, well, why should I take action now? Why not sit, be very defensive, and do very little? Because a lot of uncertainty today. Obviously, uncertainty related to the tariffs, Trumponomics. The world is in this environment where we're sailing along sort of comfortably, and now it's the call it blood in the street, uncertainty in the street, depending on how you look at it.
Mhm.
Right? So the easiest thing to do is do nothing. Right? And then what I would say is this. You could do nothing. You could sit and wait for another year and have your money earn 4%. And the fact that the banks are paying 4% is giving folks incentives to do nothing, which is fine. You could also take a more conservative route. You could invest some money in that private credit, let's call them hard money lenders, get you 10, 11% yield and take less, let's call them risk. There's still risk. Where you could get a little bit more, what I call, take the Warren Buffett hat and put it on. Be greedy when others are fearful, and be fearful when others are greedy. Greed is low, fear is high. It's time to get actually a little bit greedy and be selective, of course, in who you invest with, what type of projects you invest in. But the opportunities are insane. You look at many metrics and you can get into these deals where legally I can't tell you can't lose money. Of course, legally I could tell you could lose money. But practically speaking, look at these deals and the feedback we're getting is you can't lose money. You're using low leverage, fixed rate debt with long enough maturity. You're downside protected like there is no tomorrow. You can cover your debt with debt service coverage ratio. I'm using an example, over 2. For those who understand what it is, a huge number. You can service your debt with only less than 50% occupancy. There's so many factors you could look at and say, wait a minute. And then I'm getting a positive spread between the cap rate that I'm buying it at all and the cost of money. And this spread's now 2.5% positive. This is the crazy part. Oh, on the reconstruction basis, it will only cost you twice as much to build versus 10 to buy, right?
Mm-hmm.
This is so there's so many opportunities today that begin to look like this. I wouldn't call them value, but at least in my universe, when I see these deals, I know these are great deals. Now, folks talk about ground up construction, these great opportunities, and I tell them I love that. That's a great strategy, except for I can't get a discount on ground up construction. It's going to cost me what it's going to cost me to build.
Right.
I can get a great deal in existing, but I can't get the same type of a deal on the ground up. Can you still build and make money? Sure, you can. Can you do it with less risk in existing? I believe you can, right? It's a matter of opinion if you get into the right type of deals. So the question is, why take action? And the answer is, you got to have courage. A little bit of courage, even though you're incentivized to sit in your hands. And courage, by definition, means acting despite fear. And that's the wisdom of the day.
Well, that is a great note to end on. And I really, really appreciate everything that you've given us today. And I know just when I was on the Big Mike Fund show, you know, we actually chatted for quite a while after we were done recording that show. You're a wealth of knowledge. And so for everybody listening to this, you know, go to bigmikefund.com, follow his show. As he's mentioned, he's more than happy to give you a few minutes if you need some help. Mike, any last thoughts before we sign off?
No, keep reading books. It's one thing that I can tell you through my journey. I consume so many books, and I get a new book recommendation. As I said, started the podcast by saying Howard Marks has a great book. I read multiple books on Pitch Anything. Just to give you an example, I just consume that. And there's a follow-up book and this and that. All I could tell you is get your mindset into a humble learner, and then the world will look like the more you know, the more you don't know. But it's a fun place to be, fun place to learn all the time. And every time you have a non-successful situation, whatever it is, just remember yet another book called Sometimes You Win and Sometimes You Learn. That's it.
Absolutely. Couldn't say it better myself. So for all of you that joined us today, thank you. And, you know, go out there, share this show with others, help us spread the message. The Generations of Wealth family needs to grow. And again, thank you, Mike, for your time. Till the next show, go out there, do some deals, think about raising some money, maybe start a fund. Who knows? See you next time.
Thank you.